$38 trillion. That is the real national debt of the United States as of December 2025, not a future projection, but the number right now. If you think that figure has nothing to do with you personally, I need you to listen very carefully to what comes next. Because while you were scrolling through social media and watching Netflix, the largest banks on earth began doing something they haven't done in 75 years, quietly, methodically, without headlines. They started moving enormous amounts of capital out of dollar-denominated assets. This isn't a conspiracy theory. The evidence is public treasury data, official filings, recorded capital flows, numbers you can verify yourself. By the end of this video, you'll understand exactly what's happening, why it's happening, and most importantly, what comes next. What we are witnessing follows a mathematical pattern that has appeared 3 times over the last 500 years. The same phases, the same warning signs, the same catastrophic ending. The only real question is whether you'll recognize it in time, or whether you'll be left wondering, like millions before you, how all the signals were missed. Stay with me, because the next 15 minutes may permanently change how you see money. According to the IMF's latest data, global debt has just reached $251 trillion, the highest level ever recorded during a period of peace. It's equal to 235% of global GDP. In the United States alone, debt surged from $36.1 trillion in January to $38.4 trillion by December 2025, an increase of $2.3 trillion in just 11 months. What almost no one is telling you is that this exact situation has happened before. 3 times in modern history, and each time, within 36 months of smart money exiting, the nation holding the world's reserve currency unraveled. Not similar collapses, the same sequence, the same timing, the same patterns, and the same result. The process is predictable, mathematical, and once it reaches a certain point, unavoidable. Here's how it works. Over the last 500 years, every major economic collapse has followed the same 4-stage cycle. Stage 1 is the ascension phase, when a nation rises to the center of global finance. Capital floods in from everywhere. Its currency becomes the standard for international trade. Markets surge, banks expand, innovation accelerates, and confidence feels absolute. This phase typically lasts 50 to 80 years. Stage 2 is overextension. Success breeds arrogance. Governments overspend on military expansion, foreign ventures, and domestic programs, all financed by debt. Borrowing grows faster than the economy, but few worry because asset prices keep climbing. Real estate booms. Stock markets hit record highs. Central banks print money to keep the illusion alive. This phase usually lasts 20 to 40 years. Stage 3 is the silent departure, the most critical phase of all. The smartest capital moves first. Not politicians, not the public. Institutions that read balance sheets begin quietly rotating out. No press releases, no warnings. It's just a steady shift into safer jurisdictions. Foreign investors reduce exposure. Wealthy families diversify abroad. What starts slowly begins to accelerate, typically over 18 to 36 months. Then comes stage 4, collapse. The currency loses its reserve status. Foreign central banks dump their holdings. Inflation explodes, interest rates spike, asset prices crash simultaneously. Banks fail, pensions vanish, the middle class is crushed. Political instability follows. Everyone asks the same question: how did we not see this coming? The pattern was always there, so were the answers. Now I'm going to prove it, choosing 3 historical examples. 3 global superpowers, 3 reserve currencies, the same exact cycle, and the same exact outcome. Spain was the most powerful empire on earth in the 1500s. There was no serious rival, no real debate. Ship after ships, Spanish galleons, heavy with gold and silver, returned from the Americas, carrying more wealth than the world had ever seen. The global reserve currency was the Spanish real. If you wanted to trade internationally, you needed reals. Madrid was the financial center of the known world. Stage 1 was complete. Half of Europe was ruled by King Philip II. Spanish armies were considered unbeatable. The seas were dominated by the Armada. Colonies across 3 continents poured money into the empire, and Spain spent it everywhere. A massive military presence spanned 3 continents, alongside constant wars with France, England, the Ottoman Empire, and the Dutch. The Inquisition consumed fortunes, royal palaces drained treasuries, and an ever-growing bureaucracy devoured wealth. By 1550, the Spanish government was spending 3 times what it collected in taxes, 300% of revenue. The gap was filled with loans from German merchants, Italian banks, and foreign lenders. No one panicked. Gold kept flowing from the New World. Asset prices continued to rise. Everyone felt rich. Empire looked unstoppable. Stage 2 was confirmed. Then came the shift. Quiet, unannounced, in 1555. Major Spanish banking houses began moving assets to Genoa, the Fugger family Spain's largest. Creditors started demanding repayment in gold instead of promises. They were preparing to leave. By 1556, wealthy merchants were relocating their operations to Amsterdam. Not suddenly, but gradually routing trade routes, moving inventory, opening offices abroad. Why? Because those who could read the book saw the truth? Spain was effectively insolvent. On some debts, the government was paying 40% interest. 40% is not strength. It is desperation, recorded in official documents. Stage 3 had begun. In 1557, Spain defaulted for the first time. Credit markets froze. Spanish bonds collapsed overnight. To pay its soldiers, the crown seized private gold shipments. Chaos spread through the financial system. The king promised it was temporary. A one-time problem. Everything would be fine, wasn't Spain. Defaulted again in 1560. Again in 1575. Again in 1596. And again in 1597. For defaults in 40 years, the currency collapsed. Inflation erased the middle class. Spanish power evaporated almost overnight. By 1600, the empire was a shadow of its former self. The golden age was over and it never returned. Stage 4 was complete. So where did the money go? Or to the Dutch Republic? Amsterdam rose as the new financial capital of the world. And that brings us to the second example, the 1600s. By every measure, Amsterdam became the richest city on earth. The Dutch East India Company alone was valued at roughly $8.28 trillion in today's dollars, more than Apple, Microsoft, Amazon, and Google combined. Dutch banks financed global trade. The Amsterdam Stock Exchange became the first stock market in history. The world's reserve currency was the Dutch guilder. If you wanted to do business internationally, you needed guilders. Capital flooded into Amsterdam from Europe, the Americas, Asia, and Africa. In a single square mile of the Dutch Republic, you had what would later become Silicon Valley, Wall Street, and London combined. And for those wondering where these figures come from, every number is drawn from official, verifiable sources, with documentation from treasuries, historical records, and financial archives. Stage 1, without question. Then came the wars. They always come. Between 1652 and 1674, the Dutch fought 3 Anglo-Dutch wars. They clashed with France. They battled Spain. Dutch forces operated in South Africa, Brazil, and Indonesia. All of it was expensive. Vast sums of money were required. By 1690, Dutch government debt had exploded from 4 million guilders in 1650 to 80 million, an increase of 20 times in just 40 years. To cover the cost, they printed money. Does it sound familiar? At the same time, tulip mania swept the nation. Houses sold for less than tulip bulbs. A single rare bulb could cost 10 times an artisan's annual income. Asset prices had completely detached from economic reality. On paper, everyone was getting rich. Behind the scenes, the Bank of Amsterdam, widely considered the safest bank in Europe, was secretly using depositor funds to finance government wars. Long before fractional reserve banking had a name, it was operating as a Ponzi scheme disguised as stability. Stage 2 was complete. The smart money moved next. Around 1690, major banking families began shifting their operations to London. The Sephardic Jewish traders who had helped make Amsterdam wealthy started to leave. Portuguese merchants opened offices in England. German financiers withdrew capital methodically over several years. Why? because insiders knew what the public did not. The Bank of Amsterdam was insolvent. It had been since 1672. For decades, withdrawals were paid using new deposits, a classic Ponzi structure. The secret held until it couldn't. Stage 3 was confirmed. Then came the collapse. In 1795, French revolutionary armies invaded. The Dutch Republic fell. The guilder collapsed. The fraud at the Bank of Amsterdam was exposed, and depositors lost everything. Riots filled the streets. Political order disintegrated. The Dutch Golden Age ended, just like that. In a matter of months, 150 years of dominance vanished. Stage 4 was complete. And once again, the capital didn't disappear. It moved, this time to London. Next came Britain. From the 1700s through the early 1900s, the British Empire dominated the world. The sun never sets on the British Empire. You know the phrase? At its peak, Britain controlled 25% of the world's land and 23% of its population. The pound sterling served as the world's reserve currency for more than 2 centuries, longer than any other in modern history. London was the center of global finance. If you needed money anywhere in the world, you went to London. Then came the 20th century, and with it, 2 world wars. World War I alone cost Britain $44 billion, more than $600 billion in today's dollars. They borrowed from anyone willing to lend, including Americans and their own citizens. Government debt soared from 30% to 130% of GDP. Remember that number, 130%? The United States is there today. Britain tried to stay on the gold standard. It failed in 1931, returned briefly, failed again in 1933. The system was breaking. World War II only made it worse. More printing, more debt, more promises that couldn't be kept. Britain won the war militarily, but financially it was ruined, forced to survive on American loans. Stage 2, confirmed. The silent exit began in 1949. Major British corporations started shifting. Operations to the United States, Unilever, Shell, British Petroleum. They didn't shut down Britain, they redirected investment and future growth elsewhere. Wealthy British families moved assets abroad to Switzerland, America, Canada, anywhere that wasn't overtaxed. Overregulated and declining. Then came the brain drain. Scientists, engineers, academics, and entrepreneurs left in search of opportunity. Britain offered high taxes and fewer prospects. America offered growth. The choice was obvious. By 1960, foreign investment in Britain had fallen 62% from pre-war levels. The money was leaving. The talent was leaving. The future was slipping away. Stage 3, verified. In 1967, the pound was devalued by 14.3% overnight. You went to sleep, and your money was suddenly worth 14% less. The government could do nothing. It lacked the foreign reserves to defend the currency. The game was over. In 1976, Britain turned to the International Monetary Fund for a bailout. A bailout. The former world superpower, the empire, on which the sun never set, was now begging for emergency loans like a developing nation. The humiliation was complete. The pound lost its reserve status. The dollar replaced it in global trade. 2 centuries of British financial dominance ended. Stage 4 was complete. 3 empires. 3 reserve currencies. 500 years of history. The same 4-stage pattern. The same result. Spain, the Dutch Republic, Britain. Different centuries. Identical outcomes. And now we arrive at the present, because America is no exception. In 1944, the Bretton Woods Agreement made the US dollar the world's reserve currency, backed by gold at $35 an ounce. Other currencies were backed by the dollar. System was set. America emerged from World War II victorious while Europe and Asia lay in ruins. Capital flooded into the United States. American markets became the deepest and most liquid on earth. Treasuries, stocks, bonds, real estate, everyone wanted U.S. assets. The Golden Age ran from 1945 to 1971. 26 years of dominance. Stage 1 complete. Then came August 15, 1971. President Nixon severed the dollar's link to gold. Overnight, the dollar became pure fiat backed by nothing but trust in the U.S. government. With all restraints removed, spending exploded. U.S. debt stood at $900 billion in 1980. Trillion in January 2025, $38.4 trillion by December 2025, a 4,200% increase in 45 years. And in just 5 years, the debt more than doubled. That's only government debt. Corporate debt stands at $13.5 trillion, household debt at $18 trillion, student loans at $1.77 trillion, credit cards at $1.1 trillion, auto loans at $1.6 trillion, medical debt in the hundreds of billions. Total U.S. obligations exceed $100 trillion to 370% of GDP. Spain collapsed at 200%. The Dutch Republic fell at 250%. Britain lost reserve status at 130%. America stands at 370% and rising. So how is the interest paid? Interest alone now costs over $1 trillion per year, more than Medicare. It's more than defense, more than nearly every federal department combined. $1 trillion. Just interest, not principal. How is it paid? By printing money. From February 2020 to April 2022, the M2 money supply surged from $15.5 trillion to $21 trillion, a 40% increase in just 26 months. The largest monetary expansion in U.S. history. The result? Exploding wealth inequality, massive asset bubbles, and persistent inflation. Stocks sit at all-time highs while real wages stagnate. Price-to-earnings ratios scream bubble. Since 2019, housing prices have risen 73%. Every asset class is inflated at the same time. From 2008 to 2022, the Federal Reserve's balance sheet ballooned from $800 billion to $9 trillion. Treasuries, mortgage-backed securities, corporate bonds. Everything was bought to artificially support prices. Stage 2 finished, confirmed, and mathematical. And now comes the most important phase. Stage 3. It's the exodus. In 2013, China held over $1 trillion in U.S. Treasury bonds. Today, that number has fallen to $760 billion. Over the past 10 years, China alone has sold more than $300 billion in U.S. Treasuries, public, documented, verifiable. Since 2022, Japan, the largest foreign holder of U.S. debt, has been quietly selling month after month, reducing its position by roughly $220 billion. Saudi Arabia has been selling. Belgium has reduced exposure. Switzerland is selling. France is cutting back. Even the Federal Reserve has begun shrinking its balance sheet through quantitative tightening, draining liquidity by allowing bonds to mature without reinvestment. So who is actually buying us debt now? Largely the system itself, the U.S. government, the Federal Reserve, government pension funds, and newly created money used to service existing debt. That is not a sign of strength, as desperation. And it isn't just governments. Major financial institutions are repositioning as well. BlackRock, the largest asset manager in the world with over $10 trillion under management, has restructured portfolios, reducing exposure to treasuries, increasing allocations to emerging markets, European infrastructure, Asian real estate, gold, and commodities, and diversifying away from concentrated dollar risk. Goldman Sachs has downgraded U.S. equity outlooks. Morgan Stanley has increased recommendations for foreign allocations. Bridgewater Associates has warned for years about currency debasement and positioned accordingly. It's just like Spain, Amsterdam, and London before them. The smart money is moving. Stage 3 is no longer theory. It is confirmed. Now let me explain what comes next, stage 4. The dollar doesn't lose reserve status overnight. There is no single announcement, no dramatic headline. Instead, it fades. It's gradually at first, then all at once. Countries begin settling trade in currencies other than the dollar through yuan, euros, bilateral agreements, and alternative systems. This is already happening. Brazil and China now trade in yuan. Russia and India settle in rupees. BRICS nations are building parallel payment infrastructure designed specifically to bypass the dollar. These countries already represent more than 40% of global GDP. This matters. In June 2024, headlines declared the end of the petrodollar. The reality is more nuanced, but no less important. There was never a single written contract forcing Saudi Arabia to sell oil exclusively in dollars. But the 1974 U.S.-Saudi Economic Cooperation Framework did expire. More importantly, Saudi Arabia has openly signaled willingness to accept other currencies for oil, including yuan. The practical effect is the same. Dollar dominance in energy markets is eroding. The petrodollar system isn't collapsing overnight, but it is breaking apart slowly, structurally, and irreversibly. So what happens to the trillions of dollars held by foreign central banks when global demand for dollars falls? They come home. When they do, the U.S. economy is flooded with excess currency. Inflation doesn't rise, it goes vertical. At that point, the Federal Reserve faces an impossible choice. Raise interest rates aggressively to stop inflation, making the $38 trillion national debt mathematically unpayable and collapsing the economy. Or keep printing money, triggering hyperinflation, and destroying the dollar's value. Different paths, same destination. When liquidity disappears, asset prices collapse together. Stocks, real estate, bonds. All at once, banks fail. Pension funds become insolvent. Insurance companies break. Cascading failure ripples through the system. The middle class, the group holding most of its wealth in dollar-denominated assets, gets wiped out. Savings are erased. Retirement accounts vanish. Home equity disappears. This isn't speculation. This is the pattern, and has happened every single time. And I know what you're thinking now. But America is different. We have the best universities, the most innovative companies, the most powerful military in history, and the most advanced technology ever created. So surely this time is different. That belief has appeared at the peak of every empire before its fall. In the 1500s, Spain possessed the most dominant military force on earth. It didn't prevent collapse. In the 1600s, the Dutch had the most sophisticated financial system ever built. They invented modern capitalism, stock markets, central banking, even options trading. Collapse still came. Britain constructed the largest empire in human history. Industrial revolution, global naval dominance, and unmatched trade networks did not save it. The sun never sets on the British Empire did not stop the decline. Military power cannot override economic law. Technology cannot stop currency debasement. Innovation cannot fix reckless financial management. Exceptionalism is simply the story empires tell themselves right before the end. Some will say the Federal Reserve can print unlimited money and step in to prevent collapse. History answers that argument clearly. In Weimar Germany, they printed on hyperinflation, destroyed the middle class. Savings became worthless. A wheelbarrow of cash couldn't buy bread. In Zimbabwe, they printed producing $100 trillion notes worth nothing. In Venezuela, they printed leading to inflation measured in the millions of percent. Professionals driving taxis, people eating zoo animals to survive. In Argentina, they printed triggering repeated currency resets and decades of poverty despite immense natural wealth. Printing money does not create wealth. It transfers it from savers to debtors, from the middle class to the financial elite, from workers to asset holders until trust finally breaks. When trust breaks, collapse accelerates. Every empire believes it is different. Every reserve currency believes it is permanent. They are always wrong. Narratives don't matter. The pattern doesn't ask for permission, doesn't wait for belief. It unfolds like mathematics, gravity, and clockwork. And right now, every signal is screaming stage 3. So what does that mean for you today, in practical terms? First, if most of your wealth is in dollar-denominated assets, you are exposed. This is no longer about optional diversification. It's about survival. Consider assets that historically retain value during currency debasement. Gold has been valued by every civilization for 5,000 years. Silver and commodities are tangible. Central banks cannot print them. Second, think geographically. If the largest institutions on earth are moving capital abroad, that should make you pause. Not all your money, but some of it. Look at stable foreign currencies like the Swiss franc, Norwegian krone, and Singapore dollar. Spread political risk across jurisdictions. Third, understand timing. Stage 3 is short. Historically, it lasts 18 to 36 months. Based on when foreign selling accelerated, we are likely 12 to 15 months in. That means you have time but not years. Use it wisely. Fourth, increase liquidity. Hold cash. Yes, inflation erodes its value, but liquidity gives you the ability to act when assets crash. In a crisis, opportunities appear suddenly. Illiquid assets trap you when movement matters most. Fifth, reduce debt. In a rising rate environment, heavy leverage is financial suicide. If you carry debt, pay it down now. Each rate increase makes it more expensive to service, and structurally, rates will rise after this. Sixth, invest in skills and relationships. Human capital survives every collapse. Practical abilities, problem-solving skills, and trust-based networks cannot be inflated away or confiscated. Seventh, stay informed. Those who survive these transitions are the ones who recognize patterns early and don't wait for mainstream validation after it's too late. Subscribe to this channel and turn on notifications, because the next video breaks down which assets historically performed best during Stage 4 collapses, which preserved wealth during hyperinflation, and which were completely wiped out. I'll show you what happened to stocks in every major currency crisis, what happened to real estate during Spain's defaults, and what happened to gold during Britain's decline. The cycle continues because the pattern repeats, and once you see it, you can position yourself accordingly. This isn't fear-mongering, it's pattern recognition. 500 years of economic history repeating the same cycle. There's a reason U.S. debt hit $38 trillion. There's a reason foreign central banks are selling. There's a reason major institutions are diversifying. They see the same pattern you've just been shown. Spain saw it. The Dutch Republic lived it. Britain fell to it. And now, Stage 3 is underway again, the silent exodus, the era of capital flight. The smart money is already leaving. Once you know what to watch for, the warning signs are everywhere. Stage 4 will come. The math makes it unavoidable. The only question is whether you'll be prepared or whether you'll look back, like millions before you, and wonder how you missed it when all the signs were in plain sight. The information is here. The data is verifiable. The pattern is clear. The choice is yours. Leave a comment below. Tell me what you think, what you're preparing for, where you disagree, and what questions you have.